Cost accounting is like the compass that guides a ship through the turbulent seas of business. It provides the essential information managers need to allocate resources wisely and steer their operations toward success. Among the tools in this accounting toolkit, two methods stand out: absorption costing and variable costing. Understanding these two approaches is crucial for any business leader, as each has its own advantages and disadvantages. Let's dive into the details, unravel their differences, and explore how they can impact decision-making within your organization. First, let's talk about absorption costing. Think of this method as a comprehensive approach to accounting. It recognizes all manufacturing costs, both direct and indirect, as expenses associated with the products produced. This means that when you calculate the cost of a product, you're not just looking at the materials and labor involved. You're also factoring in overhead costs, including things like rent, utilities, and even depreciation. Everything that goes into the production process is absorbed into the cost of the product, hence the name. For example, if you're manufacturing bicycles, absorption costing would include the cost of raw materials, like metal and rubber, the wages of the workers assembling the bikes, and a portion of your factory's rent and electricity bills. This method is required for financial reporting under Generally Accepted Accounting Principles, or GAAP, which means that if you're a public company in the U.S., you have to use it when preparing your financial statements. Now, let's look at some practical examples of absorption costing in action. Imagine you run a bakery. Your costs would include not just the flour and sugar for your pastries, but also the rent for your shop, the salaries of your staff, and even the electricity used to run your ovens. By absorbing all these costs into the price of each pastry, you gain a clearer picture of what it truly costs to produce and sell your goods. But absorption costing isn't without its challenges. One major drawback is that it can lead to distorted product costs. Since all manufacturing costs are lumped together, it can be difficult to assess the profitability of individual products. For instance, if you produce both high-end cakes and simple muffins, absorption costing might make it seem like the muffins are less profitable than they actually are because of the way costs are allocated. Now, let's pivot to variable costing. This method takes a different approach by only considering the costs that vary with production volume. In other words, it focuses on variable costs, those expenses that change depending on how much you produce. This includes direct materials and direct labor, but excludes fixed costs, like rent and salaries, that don't fluctuate with production levels. Variable costing is particularly useful for short-term decision-making. For example, if you're trying to decide whether or not to continue producing a particular product, variable costing can help you understand the costs associated with that decision without the noise of fixed overhead. If the variable costs of producing a product are higher than the revenue it generates, it might be time to reconsider your strategy. Let's say you're a manufacturer of custom furniture. If you calculate the variable costs of producing a chair, like the wood, fabric, and labor, you might find that it costs you $50 to make. If you can sell that chair for $100, you've got a solid profit margin. However, if you were to factor in fixed costs like your workshop rent and utilities, the picture might look different, making it harder to see the immediate profitability of that chair. Variable costing also has its own set of advantages and disadvantages. One of its strengths is its simplicity. By focusing solely on variable costs, it provides a clearer view of how production levels affect profitability. This can be particularly beneficial when analyzing which products are most profitable or when conducting break-even analysis to determine how many units you need to sell to cover your costs. However, variable costing also has its drawbacks. One significant issue is that it doesn't account for fixed costs when calculating product costs. This can lead to underestimating the true cost of a product, potentially resulting in pricing decisions that could hurt your bottom line. Additionally, because variable costing ignores fixed costs, it might give managers a false sense of security regarding a product's profitability. So, how do you decide which method is best for your company? It really depends on several factors. First, consider your industry. If you're in manufacturing, absorption costing might be more beneficial as it provides a comprehensive view of all costs. On the other hand, if you're in a service-based industry, variable costing might make more sense and simplify your accounting processes. Next, think about your product mix. If you have a diverse range of products, absorption costing can help you understand the costs associated with each one. However, if your offerings are more straightforward, variable costing might be the simpler option. Your pricing strategy is also a crucial consideration. If you're selling products at a loss, absorption costing can provide insights into how much each unit truly costs to produce. In contrast, if you're operating at a profit, variable costing might be the more straightforward method to analyze your costs. Lastly, assess your accounting system. If you have a complex system, absorption costing can be challenging to implement. In such cases, variable costing might be the more practical choice. Ultimately, both absorption costing and variable costing have their merits and drawbacks. Absorption costing gives you a complete view of your production costs, while variable costing provides a clearer picture of how costs behave with changes in production levels. Many businesses choose to use both methods, leveraging the strengths of each to gain a more accurate understanding of their costs and profitability. In conclusion, understanding the differences between absorption costing and variable costing is essential for making informed decisions in your business. Each method provides valuable insights that can guide your strategy, pricing, and overall operations. By evaluating your specific needs and circumstances, you can choose the method that best aligns with your business goals and helps you navigate the complexities of cost accounting. Whether you're a seasoned manager or just starting out, mastering these costing methods will empower you to make smarter decisions and drive your business toward success.